Hey, I'm Jason, and this is Supply and Demand Daily. Today we've got data on manufacturers' orders, the job market, and oil production. So without further ado, let's get right on to it. I'm going to share some material here, and there we go. Let's start with manufacturers' orders. So the monthly rates of change for durable goods in March of 2022 were 1.1%, and that is a little bit down from the monthly rate of change from February 2022, which was 1.7%, so a little bit smaller increase there. For capital goods orders, though, we're seeing some negative numbers in these monthly figures. So we got negative 0.2%, which is honestly really just a rounding error. But the month preceding that, February 2022, unfortunately, these indicators are lagged by 2 months rather than the typical one. But the month preceding that, it was a decrease of negative 6%. So that's not looking too good. And if you want to know more about that and what it means, join me on the YouTube for the fuller version of the Daily Note. But moving on to the unfilled orders to shipments ratio, that improved a little bit. Again, almost a rounding error. So we're down to 6.72 on the ratio. And for February of 2022, that number was 6.74. So down by 0.02, which is not great. But it's certainly improved, especially since the height of the pandemic. Moving on to the Jolt Survey. So today we got some information about the labor market and how it performed in March. So quits went up slightly to 4.5 million. That was up from 4.35 million in February 2022. And job openings are up slightly to 11.5 million, and that's up from 11.26 million in February. So a little bit of improvement there. Again, marginal, but essentially this data shows that the labor market was still quite strong in March of this year and February. Moving on, missed oil production targets. So a new OPEC survey came out today, a monthly OPEC survey to gauge production numbers for April of this year, and the results were not great. So essentially the whole block of oil exporting countries missed their production increase target by quite a bit. They increased production on net by only 10,000 barrels a day, and the target was for 274,000 barrels a day. A lot of the decrease that threw off this target came from Nigeria and Libya, and that's especially important because as the EU looks to ban Russian oil by the end of the year, they're trying to negotiate contracts to import oil from other countries, mainly oil exporters in Africa. So this is kind of going to throw a damper on their parade there. I do think that they'll go ahead with the ban though. And then this is just a chart of OPEC production in million barrels a day going back to 2018. So the average in that year was actually 31.34 million barrels a day, and now we're sitting here at 28.7. So we're still about 3 million or 2.5 million barrels a day short of where we were 4 years ago, which is considerable. And I've got a couple of other things to share, more detail to dive into. If you would like to know that information, join me on the YouTube. Thanks. Have a good one. Okay, welcome back. If you're joining me on the YouTube, I sincerely appreciate it. I'm just going to go into a little bit more detail about some of the indicators I shared, and then there's some bonus material at the end that I'm going to go over. So manufacturers' orders. The way this works is that the Census Bureau sends out a survey of manufacturing companies, and there's a bunch of questions on that survey, but essentially they ask them for dollar amounts of different types of orders that they are receiving and fulfilling. So they ask about orders, and they ask about shipments, and they ask about fulfillment, and they also ask about undelivered orders, which is the next chart after this. So for durable goods, for example here, this would be like if the Census Bureau sent out this survey and they send it to GE. And what GE is going to respond to the census is in billions or millions of dollars, how many orders they got for these durable goods. And I use GE as an example because a durable good is something that you use often, like an oven, like a dishwasher, like a dryer, something like that. And so this represents how much demand there is for these durable goods. So the durable goods orders, even though they are taken by manufacturing companies, are a little bit more of an indicator of demand than production. And the reason that I like to mention capital goods, I'm going to actually share this chart here. The reason that I mentioned capital goods is because these are the kinds of goods like equipment and materials that are going to go into the production of new goods. So this is a little bit more of a forward indicator of what the economy is doing, at least production-wise. And these numbers are not performing quite as well. That's why I called the numbers wavy in the front page of the Daily Note, because they're just not looking as good. So the monthly decrease was 0.2%. Again, I mentioned that was probably a bit of a rounding error, but for February of 2022, when we look back at what the advanced report says, because there is an advanced report for these numbers that gets released like the last week of April or something. So the advanced report for February of 2022 was actually up by 1%, I believe. It was something like that. And now it's been revised down to negative 6%. And this is something that you see when production starts to fall off, is the volatility in the numbers starts to get a little bit higher. So you'll see an advanced report with growth of 1 or 2%, and then, a month later you'll get a revision, which are not usually in the front page news. The revisions usually don't make front page news, but you get this revision that says, oh, we said it was up and it was actually down. And then the other thing that I wanted to explain here is the unfilled order to shipments ratio. So what this shows is for every unfilled order, how much was actually shipped. And in the manufacturing business, there are actually quite a lot of unfilled orders. So that's why when you take that number and you divide it by the actual fulfilled orders, which is taken by shipments, then you get quite a large number. It's 6.72. So that means that for every shipment, there were actually 6.72 unfilled orders. Or if you like, we're talking in dollar terms here. So for every $1 million that was ordered, there were $6.72 million of orders that did not actually get fulfilled. And I want to show a chart here just to put that in perspective, because 6.72 might sound pretty bad, but it's a pretty significant improvement over where we were a couple years ago. So here we have this pandemic spike, and obviously everybody's heard about the supply chain hangups, or I suppose a lot of people have who pay attention to this sort of thing. So we had that huge spike, and we're basically down back to 2018 levels. And the reason that I wanted to point that out is because the conversation about inflation lately has been very centered around the supply chains. There's snags in the supply chains. They're not working because the pandemic punched a bunch of holes in the supply chains. And basically, it's all supply's fault, and there's nothing that the Fed can do about it because the Fed is not in the business. The Federal Reserve Bank is not in the business of making stuff, so they're not responsible. But this kind of puts a damper on that story, or at least casts some doubt on it, because as you can see, we're back down to a level when inflation was quite low, so that's late 2018, and also when the unemployment rate was very low. There was a lot of job growth around that time, and we started to see, so we've seen this number come down considerably, and it's really back into normal territory. So to continue to blame everything on supply chains, I'm just not sure that accusation is founded. There are probably some other indicators that still show that supply chains are kind of, snaggy. And certainly China is clamping down on production right now with their lockdown of Shanghai and Shenzhen and all of these different major exporting cities, including the entire province of Guangzhou, which is actually a city, not a province, or maybe it's both. I need to look back in the map. So anyway, that's what's going on with manufacturers' orders and shipping. Turning our attention to the Jolt Survey. So what does this stand for? Jolt is Job Openings and Labor Turnover Survey, and this has been around the Bureau of Labor Statistics, which are the same people who publish the unemployment rate. Well, they've been doing this for about 22 years now. So they started it back in the year 2000, and now we're here. And so quits and job openings are an indicator of positivity in the job market. So the more people who are quitting their job, that usually means that they are that they're very able and feel comfortable in their ability to find a better one. So quits associated with job growth and again, positivity. That's a good sign for the labor market. Job openings are the same thing. Obviously, if businesses are looking to hire, then that means that they are expanding operations because of increasing demand. So that is generally viewed as a positive thing too. The job openings number relative to the number of people who are looking for work is also at a record high. And that's what gives rise to this conversation about the labor shortage. Now, there's a few reasons to think that there may not actually be a labor shortage. I have seen some analysts point out that, these job openings, say if you have a career fair that is put on, say if you have a career fair where a bunch of companies get together and they go into an auditorium and they're trying to hire people. Well, I've seen some reporting that suggests that the job openings count will increase even if the same job is applied for or talked about multiple times. So let's say you have IBM and they're looking for new analysts and they talk to 10 people about that specific role, even though there's only one job opening. Well, in the job opening survey, that may count as 10 actual open positions. So this may not be completely accurate, a completely accurate picture, because usually when jobs are available and people want jobs, even if it's not the perfect job, people usually go and get the job. So it's very interesting to see these record-breaking numbers, and it certainly is worth further study as to why they are so skewed to the upside. So I'm going to move now to, I think I covered everything about the OPEC missing its production targets. Saudi Arabia is still 100,000 barrels behind its target, which is really significant because we know Saudi Arabia in the Western world as, this Middle Eastern country with an endless supply of oil. They can just turn on the taps at any time if they so please. But Saudi Arabia has been drilling their basins has been drilling their oil fields for the better part of 70 years now. And so it's not incredibly crazy to expect that production might start to wane a little bit. And there's a lot of oil analysts who will also tell you, each of the ones that I listen to will actually say that that OPEC's spare capacity, by the way, OPEC is the Organization of Petroleum Exporting Countries, but most of the oil analysts that I read have said that the OPEC spare capacity that they report, which on their most recent data release was about 3.63 million. Actually, no, that's the United States. That's the wrong number. But their spare capacity was well over, I think, 2 million. And most analysts that I read say that is not true, that is not even a calculation, that's just a number pulled out of the sky. In their most recent production numbers, I also reported last week, I talked about how OPEC has been missing its production targets for several months now. And if we look at this chart here, we're still well below the 2018 average as far as their total production goes. So the data does seem to indicate that all of that OPEC spare capacity, it might not actually exist because oil prices are higher than they have been in a decade now. And so this would be the perfect time to turn on the taps and start producing. And the fact that they're not may actually signal that they don't have the ability to, rather than it just being a willingness thing. So not really sure what's going on. Well, actually, all of the data indicates that OPEC just doesn't have that much oil. That's really the story here. So moving on. So this is a little bit of bonus material that I did not include in the short daily note, but the Federal Reserve, the people who are tasked with managing the nation's money supply, this is the United States Central Bank, they are meeting tomorrow. Their Federal Open Market Committee is meeting tomorrow in D.C. to determine what they're going to do with their policy rate. Now, just to give a quick rundown, their policy rate is what's called the Fed funds rate. The Federal Reserve controls the amount of bank reserves in the United States banking system, and this is not money that we use every day to buy goods and services. It's interbank money. So if I spend my money at Kroger, then a deposit from my bank account is transferred to Kroger's bank account, eventually. And on the back end, the banks have to settle that up. And because deposits are liabilities that banks actually owe, they owe deposits to their depositors. They have to redeem them for cash at any time if their customers so choose. So this is a liability. And if the bank is going to receive a liability from another bank, then they need an asset to back it up. And so what is that asset? It's usually bank reserves. And the Fed controls that market. The Fed believes, or at least has believed for many decades, that if they lower the federal funds rate, then it will increase lending and therefore increase economic growth. So that's why people who watch markets and watch the economy pay a lot of attention to what the Fed does with this rate. And so right now, the Fed funds futures market has been pricing in a 50 basis point rate hike. So the current federal funds rate is sitting at 0.33%. And right now, if you go into the most recent data, the Fed funds futures market, which is essentially when I say market, it's just a digital market between a futures exchange, the company that will actually sell futures contracts, and all of the people who use them for speculation and for risk management. So the way that this works is that banks and trading operations, hedge funds, they will use these financial instruments to bet on the outcome of these FOMC meetings. And it's generally understood that the market settles. So the market price for the next month ahead, which is May 2022, the market settles on or about where where most people believe the Fed is going to place its target rate at the next meeting. And because that rate is currently sitting at 0.78%, that implies that the Fed is going to raise its target by about 50 basis points. Because the Fed targets a range, not a specific rate. Right now, that range is 25 to 50 basis points. And so to see this number move up to 0.78 means that the Fed is going to raise that target to 0.75 to 100 basis points, which is 1%. 100 basis points is 1%. And so that is essentially what that means. They could actually try to surprise the market. I don't know if they'll do that, but they certainly could try to surprise the market by hiking the rate by 75 basis points. We'll see what happens. But typically, at least for the better part of 25 or 30 years, this has been a pretty good indicator of what the Fed is going to do next. Because if you go to the Fed transcripts and read about what they talk about when they make these decisions, the first thing that they look at, or at least the first indicator on their pages of presentations and charts, is actually this market right here. They look at the futures market to check and see what traders, bankers, and risk managers are expecting them to do, and oftentimes they do exactly that. So that's why it's important to look at this, and why you can kind of tell what the Fed is going to do in advance when you look at this market. And if you didn't understand any of that, I'm working on a presentation that's going to be a little bit longer, but I think it'll be very helpful to understand the Fed, what it does, why it exists, how it got here, and then explaining this whole ordeal of basically what are futures contracts and how do people use them to manage their interest rate risk, and then what does that tell us about what the Fed's going to do. And I explained that here, but it was, if you don't have any background information, that was a lot in too little time. So expect that probably here in the next week, and we'll certainly see what happens tomorrow. The other thing that I wanted to point out, last thing, is this is the manufacturer's orders for capital goods. Again, a few minutes ago, I mentioned that capital goods are those goods, materials, and equipment that are going to be used to make into other manufactured goods, the stuff that people actually demand, like the washing machines, like the dishwashers, like the appliances, all that kind of stuff. And so I took this data and I did something to it that I did to some other data yesterday, which was just to adjust it by the relevant price index, which in this case would be the producer price index for capital goods, because these companies are producers, and so so that would be the appropriate price index to use. And it's really interesting to look at this because there hasn't been any real growth, at least in inflation-adjusted terms, in these figures since 2008. actually. That's when this number peaked for the entirety of the series. And so essentially what that means is that for every dollar of spending on capital goods, these manufacturers are getting less, and therefore what's being produced on the other end of their production line is actually less. And that is true going back all the way to 2008. This number actually started to turn around in late 2007. So this is true going all the way back to late 2007. Manufacturers in the United States on an inflation-adjusted basis have not ordered as many capital goods as they did in late 2008. I think it was July or August, something like that. And so that's important to keep in mind when looking at these numbers, and especially when we look at them adjusted for inflation. I will zoom in a little bit here, but we see this kind of start to turn the other way, whereas if we look at the non-inflation adjusted chart, it's still going up and going up quite rapidly. So just another thing to keep in mind, it's important to adjust these figures because what are we looking for when we study the economy? We want to see is the standard of living of the economic area, in this case being the United States, is it going up or is it going down? And charts like this tend to indicate that it's not actually going up, it's going down. So not to be the bearer of bad news or anything, but it's just something to consider when you hear data that suggests that things are going great and maybe the sentiment on the ground is things are not so great. People are paying a lot more for stuff than they were in 2019 and obviously not getting as much. So with that, I will go ahead and conclude for the day. Tomorrow we're going to talk about what the Fed actually does. We'll see if this prediction here with the 75 to 100 basis point range was right. I'd like to thank everybody for joining the long version of Supply and Demand Daily. If you have any questions, feel free to DM me on my Instagram or comment on YouTube. I'd love to hear from you. I'd love to hear any feedback as to how I can do these things better. So anyway, with that, I hope you have a good Tuesday. And yeah, thanks for joining.